All right, let's get started. Week of October 17th. I'm Will Woodall from CAP STRAT, joined as always by Mike Rarey from CAP STRAT. Hey, Mike, how you doing?
I'm good, Will. How are you?
Weather's getting a little cold. It's golf is definitely over, I think, for the year. So
Yeah,
turn to another sport. But
sure.
speaking of sports, it was quite a week last week. Not a great week. A lot of volatility came back into the market last week, both equity and fixed income, with that inflation print. So let's go through the numbers for the week and then take a look at inflation on a deeper level and talk about what the path is going forward. So.
Yeah, we'll look at returns in the equity market. You see negative returns for the week, particularly growth equities, large growth stocks down 2.8% for the week, small growth stocks down 2.6% for the week. If you look at the quarter to date numbers, so since October 1st, the S&P 500 is flat, but it's definitely been value doing better than growth thus far to start Q4. And how this sort of evolved throughout the week. First news, we got the FOMC meeting minutes from the September meeting, and those definitely confirmed a quote unquote hawkish bias to the meeting. A lot of FOMC members stating that they felt very comfortable potentially doing too much in terms of raising interest rates and erring on the side of doing too much just to make sure that they won the long-term war on inflation. So sort of enforcing this notion that the FOMC may be looking at trailing data and they may be over-learning the lessons of the 70s, which could result in them hiking too much than they need to and potentially a hard landing. So that a lot of that information was already known, but the fireworks really started on Thursday with the CPI print, where CPI headline and core both came in touch hotter than the consensus. Pretty much in line with our forecast, but just a touch hotter than consensus. And knee-jerk reaction in the morning, futures down 2%. And then throughout the day, a huge bullish reversal. And stocks ended the day up 3%. And then they gave it all back on Friday. So Thursday, Friday, it was definitely a wild ride.
Yeah, for sure. It was interesting to watch. There was option expirations in there, and so became a little difficult to see what was actually happening. And there were some hedge fund liquidations as well. So, in talking about the impact on the fixed income market, we can throw up perhaps the next chart here and look at fixed income. But the expectations. Talk about the magnitude of change on the inflation data that we got from the Fed expectations and interest rates.
Yeah, so the data hotter than expected, and it didn't materially change expectations for longer term inflation. Longer term inflation expectations in the bond market pretty much didn't move all that much. But what did move is expectations for the Fed funds rate over really the next 6 months. And it went from the consensus being a 75 basis point hike in November, 0.5% in December, maybe 25 basis points on the February 1st meeting next year, which is actually the January FOMC meeting. And that would be it. And now it's looking more like maybe 1% in November, perhaps 75 basis points in December, and then maybe another 50 basis points in February. So just tacking on some additional hikes, more front loading of interest rate hikes. And the Fed expectations are basically saying if the Fed is going to do that much more on the front end to feel like they need to defeat inflation, then the probability of recession later increases. And then they're probably going to cut more eventually, when we get to like back half of next year. Yeah. So more hikes, more cuts, and long-term inflation expectations don't move.
In the second scenario, where does the Fed funds rate terminate in January, February?
Yeah, so the consensus right now, you would tack on about another 2.25. So we're talking about getting up to 5.5.
Yeah,
potentially. So
that will give them the room then, if they decide to cut rates later in 23, to come back to something around 2-ish and have a meaningful impact, because this has been a historic rapid rise in these rates.
Mm-hmm.
So
Yeah, and
I
those.
think,
Yeah, I was going to say the front loading of Fed expectations is why you saw high quality bonds negative returns for the week. Just following that through to what's on the slide. So
yeah, absolutely. And then let's throw up the next chart, because this is a way to contextualize everything that's happened this year, and it's been one of, I guess, the worst years for both stocks and bonds in a long time.
yeah, um, this is a very simple way to show a really complex data series. You have stock returns on the vertical axis, so you can see where we're at right now, year to date 2022. That red dot down a little over 20%, a little more than 20%, and then you have the return of the 10-year U.S. Treasury note on the horizontal axis, the bottom there. And that is what is very unique about this environment. There have definitely been time periods where stocks have been down more than 20% in a year. This data goes back to 1927, looking at calendar years. But for stocks to be down this much and have intermediate, long term, well, it doesn't matter what duration bond,
Right.
just bonds in general down this much at the same time, that is something we've really never seen before. And you see it plots way over there to the left, down and to the left, 2022. I mean, there have only been 2 other calendar years where stocks have a negative return and the 10-year Treasury note has a negative return, 1969 and 1931. So it's very, very unique environment. If you were to, everybody would look at this chart and say, well, what about the 70s? I hear so much about the 70s and that it's so similar to now. If you were to take inflation out of these return numbers, so say inflation adjusted returns, the 70s would be right there with where we are today. But these are just looking at nominal returns.
Yeah, it's a great way to visualize just how difficult it's been to make money anywhere this year. So um, let's go up and look at the next chart and look at alts for the week.
Yeah, yeah, tough week for alts. Global REITs continue to struggle, just given not only everything that's going on in the housing market, but just in the global equity market in general. They're very equity sensitive, so they sort of go pretty much as equities go, especially when you have a drawdown like this year. And commodities still positive quarter to date. We had big gains for energy last week on the news of the OPEC plus production cuts, and energy just giving back some of those gains this week. So volatile, but not a lot of signal here.
Right. And we're trying to read in the inflation narrative into this is a little difficult, but I think we're starting to see the narrative of the recession start to be priced into some of these asset classes. So that could be what we're starting to look at here. And as we move into the inflation forecast, and we'll dig deeper on this, we were pretty darn close on our call as to what the numbers were going to look like. So walk us through what we were projecting, and then we can go through the details.
Yeah, the actual September inflation data, the month over month, came in pretty much in line with our expectations. Our expectations were a little bit hotter than consensus. And so, we update our inflation forecast models, and you can see our forecast horizon there out to the right in the dashed light blue and green lines. And the impact that when we went and updated our models with the September inflation release, the impact that it had was basically inflation at the very tail end here of our forecast horizon is not coming down as quickly as we had previously forecasted, and certainly not as fast as the Fed would like. And some of the reasons for that are, one input into our models is just the moving average of inflation prints. And as every single month comes in hot, that has an impact on forecasts 3, 5, and even 12 months out. So the fact that it's not coming down means it's going to be harder to get it down. So that's one thing. Then the labor market continues to be stronger than expected. The labor shortage, we have a measure of labor shortage in the economy within our models. Labor market is not softening nearly enough in order to prevent a wage price spiral. And housing prices have just stopped going up. They really haven't come down in any meaningful way that would start to say, all right, the inflation in shelter is really going to start coming down over the next 12 months. So those are the big things. And we haven't seen recession probability rise enough either. So,
So when you look at the green line, Mike, just our forecast line through the end of the year, where do we look for core by the end of the year?
It's going to be running above 6, basically plateauing through the end of the year. And that's going to be really tough. And then once we start getting to March, April next year, that's when both of these start coming down quicker, much quicker.
But probably not quick enough to prevent the Fed from continuing to be hawkish here.
Right.
So let's dig into the numbers, both headline and core, and look at September specifically.
Yeah, we'll look at the heat map. So at top, these are all the month over month data points. So we have the last 12 months worth of month over months. And if we focus first on the top, the headline in September came in at 0.4. You see that at the very top right-hand number there. And, we were talking back in May and June, once commodity prices started to come down, that was eventually going to feed into softer headline inflation numbers. And we're still seeing that. So you look at energy commodities, the energy complex down something like 20, 30% from the highs earlier in the year. And so that starts to feed into prices over the next few months. So that's the big reason why we had such a cool print in July, still cool in August. But you notice it's sort of reaccelerating. And that's primarily because of food. Food prices need to come down much more in order to really get headline down in a big way. So that's sort of where it's at on headline. The good news for headline is the base effects are very favorable. And the way you see that on the chart is if you look at the left hand of the chart and you look at, say, next month, October 2021 is going to fall out of the 12-month comparison, and we're going to tack on October 2022. Well, October 2021 was hot. November 21 was hot. And we basically have hot readings all the way through March 2022. Those are going to be falling out of the 12-month window. And if we tack on 0.4s, 0.3s, 0.5s on the front end here, naturally headline is going to start coming down on a year-over-year basis.
Right. Absolutely. And just for the viewers, explain the difference between food at home and food away from home.
Yeah. So food at home, think groceries. Food away from home, think restaurants. And, one reason why food away from home is not coming down quickly is because a lot of restaurants have been increasing their prices because they have to pay more in terms of labor costs. Not only do they have to pay more for the food that they're serving you, but also other costs associated with running a restaurant are rising as well. So that's the headline story. The core story is what is far more concerning for the Fed. Because if you just look at the past 12 months, month over month, there's no evidence of progress here, really at all. I mean, July looked okay, but the only things that are really cooling off here are apparel and transportation. And transportation, we're basically talking about new car prices and used car prices. Good news if you're still trying to buy a car, I guess, but then you have to pay 6-7% in interest if you're buying that car on a loan. So that's not working out. But if you're online shopping for apparel, yes, prices are coming down. There's sales everywhere. But the most difficult things for the Fed, if you go under the services section, the two largest weights, shelter and medical care services. No evidence of them coming down. In fact, evidence of them accelerating. And these are the things that the Fed really worries about. These are unavoidable expenses, and they eat into consumption. They squeeze out other parts of consumption. And the Fed still thinks they have a lot of work to do, especially on the shelter side. We talked about this in our video last week. What the Fed has done has, shelter lags home prices. Home prices have just stopped rising. So, we need home prices to come down to get shelter prices to come down for this to work out. So that's the tough part. That's where the heat is. That's what the Fed's most worried about.
Yeah. And so it's going to be interesting to see how things change from month to month here, but the expectations are definitely for more rate hikes in the near term. And that is going to translate into a quicker drawdown on liquidity, and our liquidity forecast hasn't changed materially, but it has sort of on the back end. So maybe explain the 2023 liquidity uptick we see.
Right. So what we have built into our model here, one in terms of rate hikes, and then two in terms of the Fed balance sheet runoff. In terms of rate hikes, we're building in the consensus from the Fed funds futures market. And so, why that line hasn't changed a whole lot is because, yes, it's calling for more rate hikes between now and February, but it's also calling for maybe a few more cuts in the back half of next year. And those things basically even out. So we have multiple scenarios. In a scenario where the Fed does not cut in the back half of next year, which is actually more consistent with everything they've said, then we don't see this little tiny pickup in liquidity year over year in the back half of next year. So that's about as good as it can look, is basically what we're saying. And then in terms of the Fed assets, well, because the mortgage market has basically stopped. I mean, there's just very little activity in terms of refinancing, in terms of people buying new homes, et cetera. That means the Fed's mortgage-backed securities are not maturing. And if they're not maturing, they can't roll off the balance sheet. And if they're not going to roll off the Fed's balance sheet, how are they going to reduce the size of their balance sheet by $95 billion a month? Mm-hmm. And so we've adjusted our forecast for Fed assets to basically say they're going to underachieve their quantitative tightening target because of the dynamics in the housing market. And so that means liquidity isn't going to be as bad as it would be if they hit their full runoff target. So that's why you see a little light of day there, out towards the end of next year.
Okay, let's just wrap it up with any significant changes over the last week or so to our GDP or our recession forecast.
So starting with GDP, we're going to take a look at the Atlanta Fed Q3 GDP nowcast. This has been a very interesting data point to follow. If you actually look at the line in the chart, that's the actual nowcast. So expectations for the Q3 GDP number that's going to come out officially at the end of this month. And you see right around the end of September, it shoots up. And so where is that coming from? Does it matter? Because now we're saying we're going to have a nice quarter, 2.8% quarter over quarter is the expectation for Q3. But if you start to dig into what's happened here, that rise in the GDP nowcast coincided with advanced economic indicators being released by the Census Bureau. And the primary impact those had were net exports got way better. So if you were to separate these data points into net exports and change in private inventories, those explain all of the expectation for growth, basically. If you look at government spending, residential investment, business fixed investment, consumer spending, net, those are still tracking with sub 1% growth in Q3. So this number that we ultimately get, it's going to feel worse than it is, because what's been happening is net exports have been revised up because our imports are falling. We're just buying less stuff. And we're selling just as much. So because we're buying fewer things from overseas, our net export number is going to be much higher than previously expected, and we're probably going to get a decent GDP number.
Yeah. Okay, and just any significant update to recession forecast before we take some questions?
No significant updates. Still looking at, very low probability that we're in a recession now, something like 21% chance versus 6 to 12 months out, still elevated, still warrants more conservative portfolio positioning.
All right, Audra, let's see. I know we have some questions in the queue here. What would have to happen to drive inflation below 2% again? Wow.
Yeah.
That's a big question. A lot of time.
Yep.
Big recession.
Well, the good news is, in theory, if all prices in the economy just stopped going up for the next 12 months, inflation 12 months from now would be zero. So, it seems like a tall ask. What would have to happen for inflation to be below 2 again? Well, 12 months from now, all the prices just have to go up 2% or less. And that's not that difficult. But in reality, what probably needs to happen is home prices need to come down. Labor shortage needs to clear up. So we need some softening in the labor market. And we probably need a period of subpar or recessionary type economic growth to bring demand down. I mean, those are probably the three things.
Yeah. Unfortunately.
Mm-hmm.
All right, next question. What is the most important data to watch for the rest of 2022? I mean, I think we've consistently thrown that data in front of you. Obviously, it's the key data points in our investment framework.
Yep, for sure. If anything in addition to what we think matters, which is obviously inflation, liquidity, economic growth, recession. Aside from that, job openings. Job openings are really important. Can the Fed pull off a soft landing? Can they somehow reduce job openings to a reasonable level without anybody actually losing their job? And can they bring inflation down because of that? So if we can continue to see this progress, job openings coming down without any increase in unemployment, and somehow we get inflation start to come down, then there's going to be a narrative in the market that the Fed can cut and they're going to pull it off. There's no historical analog. I'm not saying they can't do it. I'm just saying they've never done it before ever. But if that were to continue, that would be very bullish.
Yeah, absolutely. All right, next question. What insights do you have for markets in 2023?
Yeah.
Got lots of thoughts there.
Yeah, the first thing that comes to mind, Will, the chart that we showed earlier showing that 2022 is going to end up being maybe the worst year for stocks and bonds simultaneously ever. And you think about our framework, well, bonds look extremely attractive. So pretty much whether there's a soft landing, hard landing, or anything in between in terms of the Fed, fixed income, just the prices and the yields we're seeing relative to the economic fundamentals right now look very attractive. So, 2022 might end up being one of the worst years ever for high quality bonds. It's possible 2023 could be the exact opposite.
Yeah, for sure. Yeah, absolutely. All right. I think we have one more question here. For a nervous investor, what can we actually control now? Well, your nerves, for one thing. Your allocation is obviously one of the biggest things you can control. Your time horizon dictates your allocation, and you should always be thinking about your time horizon and making sure that you're communicating that time horizon so it can be reflected in your investment portfolio. Yeah, so that'll wrap it up for this week. Thanks for joining us. So we'll look forward to talking again next Monday. Have a great week.